If you look at the S&P Global Commodity Index, it is almost flat so far this year. We are now joined by one of the men behind this index. It's Michael McGlone. He's Senior Director of Commodity Indexing at Standard & Poor's. Michael, thank you very much indeed for joining us. Can I just get you a comment on what Patrick McGlone was just saying there? Gold is still where it's at. Gold could continue to rise. Everything else is looking a bit iffy. Is that how you sense things at the moment?
Well, gold is a quintessential non-income producing asset, as commodities are non-income producing assets. And a lot of people claim gold isn't a commodity, it's more of a currency. And what's the underlying foundation to support gold? Zero interest rates, financial volatility. Is that going to change or accelerate? And I think when you look at the price of gold, for the last decade, it's been rallying for that reason. Interest rates have been declining. They're almost near zero. And financial volatility has continued to increase as the S&P 500 has declined. So if that changes, gold rally might change, but otherwise it's a trend is your friend.
Now, the Fed talks of significant downside risks. We've also got stimulus, and nobody's cheering. So what on earth is going on as far as commodities are concerned? We're already seeing copper now in something of a bear market.
Well, you mentioned copper. I think copper is significant because it's an industrial metal. Industrial metals have been declining, precious metals have been increasing. And when we look at our indices, we like to measure, one way to measure an economic indication is the spread between the S&P, GSCI, industrial metals versus precious metals. That spread has been declining, which is a high correlation to the S&P 500. On your Bloomberg terminal, if you do an HRA, a regression analysis on the two, it's very high. And it's showing a very negative indication. So in terms of commodities, though, right now, in the short term, they're subject to the world's most powerful force, and that is when the S&P 500 goes down a lot. And that's what's happening now. But the significance there is the S&P 500 is in a bear market. It has been in a bear market for quite a while, and this year it's just kind of catching up. But also, it's what happened last week. Last week was Triple H Friday. And it's eerily similar to what happened 3 years ago in September of 2008. Triple H Friday in September, the market rate went right around 1,200, took out a lot of shorts, and then went down. And it's essentially that's happening now.
What's happening with oil right now? Are you expecting something of an upside correction and then falling right back down, or are you sort of like fairly negative on it?
Well, we don't really. Bottom line for us is we measure markets. We don't really predict markets. But oil has a very high correlation, or energy, very high correlation to the S&P 500. S&P 500 is going down. Oil's going down. But I think one of the significances is how you define oil. There's two main oil markets.
Sure.
There's WTI crude, which is landlocked in the U.S. There's more supply coming on. Demand's declining. And then there's Brent. There's seaborne Brent. Seaborne Brent supply is declining, yet demand is increasing in all emerging markets. So I think there's a big major dichotomy there. Brent has done well this year. WTI is flat or declining. But overall, oil, crude oil, together will reflect equities in the S&P 500.
Michael McGlone, we're running out of time. We have to leave it there, but thank you very much indeed for joining us on Bloomberg today.